My name is Andrew Stotson. I want to welcome you to the Valuation Master Class Show. And today I'm going to answer 6 questions from students and other people who have asked. And if you don't fully understand EV or EV to EBITDA or free cash flow, today I'm going to clarify that as best I can. If you like the presentation I give, I have it as a PDF. All you have to do is email me and I'll send it to you. I'll put my email right here in a second. But before we get started, let me tell you a story about something that really annoys me. It really annoys me when I hear people say, capitalists, all they care about is profit. You ever hear anybody say that? Well, from now on, you're going to know exactly how to reply to that nonsense. And that's the answer to the last question. Now, just to review, the questions that we're going to cover are these 6. How do you calculate EBITDA? How do you calculate free cash flow of the firm? How do you calculate invested capital? How is EBITDA used in valuation? What are comparables for EV to EBITDA? And how to use DCF to value a business. That thing I'm really annoyed about is question number 6. I'm going to answer right there. So let's get into it. I'm going to take a look at this. This is the first question, which is how to calculate EBITDA. So I've done a calculation here that helps you to see this. I've used year 2023 and 2024 for an anonymous company, and it's in $100 million. So it's in $1 million. So you can see that if we look at the revenue of 2023, it's 169, cost of goods sold 93, and gross profit 76. And if you look to the right of that, you can see as a percent of revenue. So this is a common size breakdown of the P&L. And what you can see is a gross profit margin in 2023 of 45% and a gross profit margin in 2024 of 42%. EBIT margin, or what we call operating margin, is at 5% and 7%. And net profit margin is at 3% in 2023 and 5% in 2024. Now, here is where what we can see is in a typical P&L, you're not going to see the depreciation and amortization. It's in there, but they'll never show it on a P&L. Where do they show it? Well, you can get it from the cash flow statement. So you can see here, I've grabbed the depreciation and amortization from the cash flow statement, and it's about let's say $7 million. But the thing is that free cash flow allocation is going to be allocated both to cost of goods sold and to SG&A. And that breakdown, I'm going to assume, let's say, is 70-30, roughly. That's probably roughly what that breakdown is, but we're never really going to know. Only company insiders will know in the accounting department how much they're putting into depreciation, into cost of goods sold, and how much into SG&A. Now, before we go on to that, I just wanted to, mention about this for a second. So when we're talking about this concept, I'm going to go back into the slide in just a second, but I just want to explain this a little bit better because in my coffee business, Coffee Works, as an example, we have 2 parts of the business. You can think about any manufacturing business, at least in this way, but pretty much every business. One part of the business is the actual manufacturing or creating of the product and service. In Coffee Works, it's a factory with people roasting coffee, with people in the warehouse handling green coffee. And then we have packaging people. And those people are all focused on creating the product. Now, warehouse is not always included in creating the product, but we can say that roasting and production related employees are there. Now, also, if we look at SG&A, SG&A is the management, the accounting, the marketing, the sales. All of those things are not related to making the product. They're related to running the business. So SG&A is about running the business, and cost of goods sold is about making the product. Now, let's imagine that in the factory we have a big roasting machine, which we do, and that roasting machine is a fixed asset that's in the part of the company that's related to making the product. And therefore, that fixed asset will be depreciated, and that depreciation charge will be added or costed into that charge of the cost of goods sold. But now let's go to the office where the management team is and the salespeople are. They're sitting at desks operating computers. Are desks and computers assets? Absolutely. And so they need to be depreciated also. And so in both cost of goods sold and SG&A, there is depreciation. But companies do that internally, and then they get a final depreciation and amortization line. So let me go back to that line here for a second. So that's what I'm saying when I'm saying allocating maybe 70% to cost of goods sold and allocating 30% to SG&A. Now, in CoffeeWorks, as an example, since it's my company, I can go in and ask the accounting team, what is that actual breakdown? But let's just use this as an example. Now, let's now get down to the idea of how are we calculating the EBITDA? Well, all we have to do is take the EBIT, which is the operating profit, and we can see in 2023 that was 3, and in 2024 it was it was 8. In 2024 it was 13. And we can also see that EBIT, as we looked above, is 5% of revenue and 7% of revenue in 2024. And then we take depreciation and amortization that we got from the P&L. Now, I've already shown you the percent allocated to cost of goods sold and percent allocated to SG&A, but we're not going to actually use that in this analysis. We're just going to, I just showed you that to get an idea for you, but we're just going to use a total depreciation and amortization, and we're going to add it back to the EBIT. And so when we do that, we get EBITDA of 15 and 20 for the period, and that's 9% of revenue and 10% of revenue. Okay, let me talk a little bit about this before we continue on. In my business, I don't use EBITDA that much. I just use EBIT. Part of the reason is because what I care about is clarity and understanding in the management team. And they understand the EBIT just fine. And since the depreciation is a cost, it needs to be included. And that's why we use EBIT. It includes all costs. So the question is, why would people use EBITDA? Well, basically, what they're doing when they're using EBITDA is a couple of things. The first is they're saying, well, what's the cash that our business generates? Well, you could say the depreciation charge in the P&L that is included in EBIT is a non-cash charge. And therefore, EBIT is a calculation of profit, but it's not a calculation of cash flow. And so you could say that by adding back depreciation, you are coming up with a estimated calculation of cash flow. And that's why the number is also higher. So let's go back and look at it for just a second. And so you can see here that EBIT in 2023 was 8, depreciation was 7, therefore the combination of these two was 15. So EBITDA is always going to be higher, always going to be higher. And that gives you a picture of you could call it, now people call it cash flow, and I want to talk about that for just a second. Whoops. And let me now talk about EBITDA from a cash flow perspective. So from a cash flow perspective, it's not really cash flow because that cash still has to be used. It has to be used for a couple of things. It has to be used for investment in net working capital. It has to be used for CapEx. So you can't really say it's like free cash flow. It's definitely not available to shareholders. Now, what we can say is we can look at EBIT and you can look at EBITDA and say, well, it's cash that could potentially be distributed to the 3 investors in a business. The first investor is the shareholders, equity investors. The second are debt holders or lenders to a business. They provide capital. And the third is the government. They don't have to provide any capital, but they give you the license to operate. And if you don't have a license to operate, you can't run. And so that EBITDA number is available to pay taxes, it's available to pay interest, and it's available to pay dividend. So it's not a bad measure. It's a measure that gives you some idea of what a cash levels the company is spinning off. But it's not a cash flow measure specifically. So now let's go to the next one. And the next one is going to look at the question, how do you calculate free cash flow to the firm? Well, I like to do it in a 3-step process. By the way, I put my email right there. So if you want this presentation, just email me at Andrew Stotts and say presentation. And so how do you calculate this free cash flow to the firm? Well, there's 3 steps. First, we start with the EBIT, which in this case is 10. Let's say the tax rate is 20, and then the NOPAT is 8. So this doesn't perfectly match up with the prior example, but we can see that we have to first take EBIT and reduce it by tax because you have to pay tax. And then we end up with net operating profit after tax. Then we add back depreciation, and that gives us what I call cash net operating profit after tax. So this is the adjustment in step 1, and that gets us from 10 to 19. But the next thing we have to do is we have to spend on the change in net working capital. And that's step number 2. So you can see we're going to look at the change in accounts receivable, the change in inventory, the change in other current assets, and that's going to give us the change in current assets total. And in this case, you can see that this company received cash from its accounts receivable, which means that it collected its accounts receivable very quickly. Now, let's look at the change in accounts payable, which is -7 in this case. That means this company paid out. In other words, that's a cash outflow in that period. And the point is that when you have a cash outflow, it means you're paying your suppliers actually quite quickly. And then if we look at the total change in current liabilities, it's -8. And the sum of these two is the change in net working capital. And in this case, it's 2. Now, before we go on to the next step, I just want to talk a little bit about this one because it's important to understand that the change in net working capital in general is always going to be negative. You have to spend on inventory and accounts receivable if you give your customers credit. So you have to spend on these things. And so you can't say that that's not part of the ultimate cash flow. And this is where free cash flow of the firm is probably the best measure to use. And we use it in analyzing my own business, and I use it when I analyze other businesses. So this gives you just this idea of step number 2. And then the next step is CapEx. And CapEx is the amount of investment in fixed assets that the company has done. And in this case, let's say the company has done 12 in CapEx. Well, if we take the 2, the change in net working capital, and we take the 12 in CapEx, we have a total level of investment of 15. And then we can calculate the free cash flow of the firm by saying the 19 minus the 12, the 2 minus the 12, which those two add up to 15. There's a little rounding error. And we can end up with a free cash flow, in this case, of this company at 4. So that gives you a picture of how I look at calculating the free cash flow. The key thing about this is that when I look at free cash flow to the firm, I basically say, company's generating cash. You gotta spend on working capital, and then you got to spend on CapEx. Now, if you can keep those things down as low as possible, then you're going to generate more free cash flow to the firm. All right. Woo. It's a lot of numbers today. Okay, how do you calculate invested capital? I've taken the balance sheet of that company and I looked at the total assets, which were 107 million and 29 million. And then I said, well, there's short-term debt and there's long-term debt. That adds up to, oops, my calculation is a little bit wrong there. Actually, the combination of short-term and long-term debt adds up to, so my calculations is wrong in this one, and I'll fix it in the presentation. You just send me an email and I'll fix that. But you can see that the total debt shouldn't be 145. That's the total debt, which is 22 plus 16, so 38. Then we have to take away cash, so 38 minus 2 is going to give us 36. And 36 plus 107 would give us our invested capital. So that is 36 plus 107 is 140, what was that? 143. And so now we've got 143 as the net debt. And then, which, no, that's not right. Hold on. Sorry, invested capital is 143. And then what we end up with is we have to then multiply the price times book times the market value times the book value of equity, which is 107. So 2 times 107 gives us 213. And then we end up with the enterprise value. Now, this time it's a little messed up. I got to fix that calculation because I didn't calculate the correct level of debt. But basically the way to think about it is it's equity and debt. Those are the two invested capital items. That's what you have to put in the business. And invested capital includes the interest-bearing or dividend-paying capital. And then you subtract the level of cash from that debt. And then you look at the market value of the equity. And so if we look at the next one, we then can calculate. Now, for a moment, let's imagine that my numbers are right. And we end up with a enterprise value of 356. Now, enterprise value is the market value of the equity plus the net debt. And so we end up with an enterprise value of 356. Then we can look at the EBITDA and then look at it and say, what's the relationship between EV and EBITDA? And in this case, enterprise value divided by EBITDA gives us 23 times. So this gives you a little bit of a picture of how to think about EV to EBITDA. You add the debt, you take the debt and you subtract the cash because we could pay back, we could use that cash to pay back the debt. So we don't need all of that debt. Then you add the equity and the equity should be at market value. And then once you've got that, then you look at the EBITDA relative to it and you say EV to EBITDA. So the next question was related to comparables. And here we can see a table that I made for you that gives you some comparables. This is EV to EBITDA for regions. Now, what you're going to notice is that I used price. I didn't have time to collect and add in the debt to say EV. So I ended up just using price. And so, but that's fine. We can compare relatively with that. So price to EBITDA is 12 times across the world. But we can see in the developed world, it's at 13 times. And in the emerging world, it's at 6.9. Now, what you also notice is that the ROE is higher in the developed world and lower in the emerging world. And I did a study, which I didn't show in this, where I just looked at the correlation between various measures, net margin, EBIT margin, and ROE relative to the EV to EBITDA. And what you will see is that ROE is a good measure that correlates relatively well with EV to EBITDA or price to EBITDA, which I'm using. And so that's why I'm showing you ROE in that table. So now let's go back, and this table is looking at the relationship all the way over on the right. We're looking at the price to EBITDA. So what's the multiple divided by the ROE? And the end result is you can see that that multiple, is changing. Now, what you'll see is that the emerging world has a 0.6 multiple, which seems to be a little bit more attractive, possibly, then because it's cheaper relative. But that depends. There's a lot of factors to consider in there. Now, the next one is looking at countries. Now here, I've got a list of countries, and I'm looking at their price to EBITDA. And I'm looking at that ratio. Now we can see that basically in Hong Kong, it's a 1-for-1 ratio. What you're paying is in multiple is almost the same as what you're getting in ROE. Let's look at one that's much, much lower. How about UK? What you're paying in multiple is very low relative to the ROE that you're getting. Or let's look at Indonesia. What you're paying in multiple is very low relative to the ROE that you're getting. And so in this case, we can see also that India is a bit expensive. You're paying 15 times price to EBITDA, but that's roughly what you're getting in return. Now, this isn't a perfect measure, and there's things that you can challenge about it, but overall, it's a good measure to understand comparatively where countries are sitting. So if we were just looking at what's the most value for money we thought right now, it could be Indonesia, it could be Philippines, it could be Germany, it could be UK. And where we see things are a bit expensive, well, how about Singapore? What about Hong Kong? What about India? But what's interesting is the US. It's incredible that even though the US is at 16 times EV to EBITDA, it's generating a 20% ROE. And that means that it's about in line with the global average. Now, the global average is 60% weighted in the US, so it's a little bit unfair. But the point is that the US is not that much out of line. So this gives you a picture of how you can use comparables. I have one other way of looking at it, and that's by sector. And here we can see the various sectors, and I've calculated the price to EBITDA, the ROE, and then the relationship. The relationship that I show on the right column just gives you an idea of where to look and how to understand it. So if we look at energy as an example, it's 0.3 price to EBITDA divided by ROE. And that signals to us that the price to EBITDA is super cheap relative to the ROE. Now, let's look at the opposite. Let's look at real estate, where the price to EBITDA is very high relative to the ROE. Now, real estate's a little bit of a tricky one because they don't have much depreciation. So EBITDA actually looks a lot like EBIT. And let's look at infotech. You're going to pay 25 times price to EBITDA, incredibly expensive, but you're going to get 26 in ROE, which is pretty incredible. So it's a little bit more expensive than the global average, but it's not as expensive as we can see real estate as an example. And let's look at utilities. Utilities at 6.1 versus an ROE of 11.2. And that is, interesting. But let's go back to energy for a moment and look at that 4 in price to EBITDA relative to 14 in ROE. And let's just talk about that for a bit, because I think this will help us understand how to use these multiples. You can never really use a multiple at a point in time. That multiple at a point in time is a guide, right? It gives you an idea of what things are right now. But we need to ask the question, well, what has it been in the past? Let's say that the EV to EBITDA of the energy sector is at 4 times, but it's never been higher than 5 times, and it's been as low as 2 times. Then, it's not that attractive. But let's imagine that we look back at a historical graph and we said, well, that EV to EBITDA for energy used to be much, much higher. So now I'm going to buy energy companies. Now, there's another way to think about it also, and that is that valuation is all about the future. What I'm showing you there is the past. So you have to ask the question, well, it's cheap for sure, relatively good ROE. Then the question is, can earnings accelerate or are they decelerating? Because momentum is an important factor when you're thinking about valuing a company and what to do. I had some questions, so I'm going to answer those a little bit before I get to that final slide with that question that annoys me. Yep, Petch, good to see you. Yep. Yeah, study group. I want to join Valuation Master Class. Please consider joining. Just send me an email, right? Just send me an email at me@andrewstotz.com and I'll give you more information. And you also said, I took the test and sent the academic excellence certificate, but I haven't received a response. Well, then reply to me, because that means you're already in my inbox. So send me a message right now and say, can you help me follow up on this? DP says, it took me 3 books and countless articles to finally get a clear understanding of EBIT, EBITDA, and the other profits terms that we often use. This exclamation made the whole structure clear instantly. Yay, happy to see that. And Lee is saying the presentation slides will be a very useful tool to refer to. Yes, I just got to fix that one table. You make mistakes. I rushed to try to get this out here, and so that's a little mistake. The reason why that mistake is there is because at first I was just showing total debt, but I thought to myself, well, I want to show everybody that there's short-term debt and long-term debt. So I added it in at the last minute, but I forgot to sum it up. It happens. Let's see. Abdur says, at times it's very tough getting the EBITDA. Some entities doesn't classify their statement of financial position properly, just like including expected return and the interest costs of planned assets. Yeah, definitely. There's a lot of companies that it's hard. Now, as an analyst, all my career, the first thing I do is ask the company, can you help me understand what this is? And they're going to say, no, we don't reveal that. Or they say, yeah, here it is in the financial statements. So in this case, make sure that you're ask the company, if you can you give me more information on that? And also, Abdur says at times it's very tough. Yeah, okay. Yep, operating activities, exactly. And let's see, last question from Roman. If a semiconductor company spends about 2% of sales on CapEx compared to 6% industry standard due to outsourced manufacturing, would this result in a higher valuation? Well, yes and no. Valuation is, a complex thing. A good example, which I use in Finance Made Ridiculously Simple, which you've already seen because I know you've been through it. And that example basically is saying, let's compare Louis Vuitton, LVMH, to Uniqlo. And Uniqlo basically outsources most of its manufacturing. And so the result of that is that they have a different structure. But the market will compensate for that. Sometimes the market will sometimes say they prefer a company that controls its manufacturing. And sometimes it'll say that they prefer that it outsources manufacturing. The kings of this are Apple and Nike. Apple in particular outsources all of its production. Does Apple get a high valuation? Definitely. And so it really depends. I wish I could say that there's an exact answer for that, but really you've got to look at the different factors. But the purpose of the well, first of all, EBITDA can be helpful to understand the level of depreciation in the two companies. And then, you want to look at it. Now, there is another point, Roman, that's interesting, and that is that many companies that aren't listed in the stock market basically have run down their assets to zero. And so in that case, their depreciation is really low, their profits are really high, and their revenue, their asset efficiency or asset turnover is really high. It looks great because they've run down their assets. You know that if you were to take over that company, the first thing you'd have to do is invest in these assets. So that's another thing. We're running out of time, so I'm just going to try to go through. So how do we assess the valuation of a private company is reasonable or not? Well, the first thing is with private companies, you don't get a lot of information. So first question, Michael, is going to depend on what information we get. Second question is, how much contact do we have with the management? If we're working with the management, then we should be asking for every bit of information to do that valuation. But if we're an outsider doing that, then we're going to have much, much less information. And the fact is, we're not going to be able to get as much. But if we can get the information, we can do a complete valuation. And how do we assess the valuation of a private company? Yeah, is reasonable. Yeah, I would say that answer right now, one of the things is mainly if you have two companies that are identical, but one is listed and one is not, the one that's listed is going to trade at a higher premium on multiples because there's no liquidity risk. You can get out of it and get into it very, very easily. So I just want to wrap that up by going back up to the first slide that I had where we just went through these 6 questions. Now, I'm sure you got a lot of questions, and feel free to, even after I've done this live, put your questions into the chat, and I'll be sure to get that next Friday when I do Q&A. And also, as I mentioned earlier, just send me a slide here. Send me an email, and in that email, you just used my email, which is, why my screen's not coming up properly. Hold on one second. There it is, me@AndrewStotz. So I'm going to wrap up there, but I appreciate your questions. This is Andrew Stotz, and this is what I am trying to do here is help you understand about valuation, answer your questions, and explain the things. So if you want to build a competitive advantage in company valuation, join us